first rates will just start coming up on your screen now. You got a 72-point uptick on the Nifty. You got 0.5% uptick on the Bank Nifty. So it's a good start. It's a decent start, and for a change, the market breadth is looking charged up. So from the yesterday's low, it's been almost a 200 plus point swing for benchmark indices. 16,800 now is 17,100, almost 17,100. What is taking the markets higher? Now, there is no large newsmaker per se. It has to be in combination of news plus large heavyweights. So you got Reliance, which is up by 1%. ICICI Bank is giving Reliance some company. You got Adani Ports looking strong. HCL Tech looking strong. So is it that turn? Is this that big turn which we've been talking about both at a global level and at a local level? That is something which I think is the most important takeaway for me.
Yes, for now it does look like it's a very smart open. The advanced decline ratio, as you pointed out, 1300 to around 250 stocks declining. The Bank Nifty is also doing its bit, up around 0.4%. Very broad move, because if you look sectorally, there are a lot of sectors actually trading in the green. Nifty Metal is your top gainer, with the likes of Adani Enterprises, Jindal Stainless gaining quite a bit. PSU banking space has also managed to perk up. So you have Indian Bank, Maharashtra Bank, IOB, etc., which have opened with a big thumbs up. But stock specific, there is no big mover as such. You have Sterling and Wilson Solar, which is opened with a gap up of 5% on account of that big order of 2,100 crores that the company has bagged. You also have UTI AMC, which is higher by 5%. Adani Green, Alok Industries, Fluorochemicals are some of the other gains on the top gainers. IGL, remember there was this note coming in from CLSA this morning. Maybe a bit of reaction coming into that. On the losing side, you have names like GAIL, which is down 3%. National Aluminium is also down around 2%. So no big movers as such, but it's a very, very broad-based move that we are witnessing at this point at the index level. Let's go across to our technical experts to understand how they are tracking the market opening, because we are just around that 17,050 mark for the Nifty, and the Sensex is also up around 200 points. Nooresh, your first trade?
So playing for a bounce back trade on Infosys at 1400, a very small stop loss at 1380, could expect a bounce back here.
But you, Kunal, what are you strategizing at this point of time? Anything that catches your attention?
So it's ITC. I believe that stock should make a strong comeback for itself after correcting from 394 to 360 approximately. So that's a trade which I would look to strategize.
Okay, let's connect with Bala Subramaniam, Managing Director and CEO with Aditya Birla Sun Life AMC. Bala, good morning. Thank you for joining us. In your understanding, what is happening in the world? Is the pain now nearing its end, or we are in for some more days of volatility? More bad news could come in, because like they say that once the bad news starts in the financial sector, it just does not stop at one or two.
I think it appears the way I think things have been shaping up over the last few days, and banks like SBI was declared, that's something one has to worry about it. I think given the fact that US has got a similar kind of banks, close to about 100 banks, we can call it regional banks and so on and so forth. And also having understood what could have led to the problem of SVB, which is more in the form of ALM, in the form of not being mark to market all the securities that they have in the portfolios, not raising deposit rates in line with what the Fed has been doing, unlike what India has been doing, far better job compared to the US. So all such things, I think, pose a question mark that how many such banks, I think, would have a similar risk practices being adopted as is being done by the SVBs. Therefore, I think immediately after that, the fallout of CSFB, all that actually is an indication of the financial market in general in the developed market is not as good as, is not in good shape as good as what we have probably would have seen in India, given the fact that Indian balance sheets, banking balance sheets are far superior, well constructed, mark to market is it's an ongoing basis is done, capital adequacy is very high, and compared to that, I think it looks like there will be many discoveries will come. Also, given the fact that I think the way the Fed historically has worked, and to ensure that at least they come and provide necessary support in the form of liquidity pumping in. I think the challenge for US is managed between inflation expectation on one side, and second is the liquidity needs of the other side, and also bailing out some of these banks on the third side. I think they have to do a right balance between all the three. So in our own belief is, I think that given the fact that historically the Fed has ensured the financial market systems comes back to normal, I think they will also take enough steps actually to provide necessary liquidity in the systems to ensure that the banking system do not suffer, at least from the consumer's point of view. But I think as things progress, it looks like it's not going to stop only with the two that has been already that already come. Probably we'll see more and more small things keeps coming in and affecting the market sentiment, keeping the overall market volatility for some more period.
So markets are headed lower because if you expect small or big, large or tiny does not matter. If more and more skeletons will come out of the cupboard, that means financial markets will remain volatile.
Yes.
And in this case, the direction could be down.
I think probably yes. I think direction could be down.
Fund managers don't talk like this actually.
I know. I know we don't speak, but I think given the fact that I think the volatility in the market has been quite high, and I think too many variables that I think one has to look at it. But I think one good thing is at least the commodity prices are coming down, especially oil coming down. Definitely could have some kind of positive impact. And the commodity prices being low, I think will have some bit of positive impact on inflation. But still, the financial market current discovery that has happened, we'll have to probably keep, I would say, one has to be a little guarded, given the fact that the cascading impact of that, it could come in the credit market and so on and so forth. I think whenever I have seen historically, the financial market sentiment gets impacted, it does have a cascading impact on the equity market, given the fact that the banks have been funding the finances globally, especially in US. The last few years, a lot of funding has gone through startup companies, funding has gone to the PE firms and so on and so forth. So therefore, the impact of that, I think, is very early to judge what kind of impact could come. Therefore, it's time still to be cautious, I would say.
So, given the fact it's time to be cautious and the FII flows have been quite tepid, in fact, we have seen outflow to the tune of 2,500 crore yesterday, also, and the long position is also very low. What was supporting the market till now was the DII flows, and the retail participation was quite strong. Given the momentum is a bit weak, and we have been seeing that the volumes are on the lower side, is there a case to be made that the retail participation and the DII participation will also wither away?
I think historically, again, if you go by the trend, compared to what you have seen in the past and we are seeing today, I think investors' maturity levels in India have gone up quite significantly. And given the fact that the money is being now taken in the mutual funds in the form of SIPs for long-term investing, and people have been coming for perpetual SIP, people are coming for 10-year SIP, all keeping goal in mind that they are coming. Therefore, there is a greater understanding that got developed in Indian investor psyche that I am looking at investing for long term, not for the short term. So therefore, I think money flow will continue as far as the Indian equity market concerns. Second is, I think since the time the government of India introduced PF can invest up to 15% in equity, I think every year an accrual that is coming into the PF, the naturally is coming into the equity market and gives that day support as well. But while of course it's obvious to understand that whenever the market turns volatile and whenever the recency of performance which has been driving the investor decisions, then naturally to the extent those who are driven by the recency of performance, I think would probably hold back. But otherwise, I don't think this comes at the cost of significant slowdown in terms of domestic flows coming in. I think from a fundamental point of view, India, I think where we were maybe about 3 months back in terms of levels and where we are today, for valuation wise, I don't think we can probably say that we are too costly. I think we probably can say that we are almost the average of last 10 years, but we are not costly. Stocks have corrected quite well, and therefore, in any parameter, if you look at it, and whether it is dividend yielding ratio basis or on the PB multiple basis or any other fundamental principle on which if you look at it, I think Indian valuations are relatively better. I think the overseas outflow, I think is a function of what we are seeing in the global market, and also I think there is general withdrawal risk of trade. We can probably say the general withdrawal from equity in the global market could be one of the reasons why we are seeing FII selling coming in. But the moment I think you will see get some kind of indication that comes from Fed, I think they are going to cut the rate. It's not going to come immediately. Let us assume a scenario this week there is a meeting and then they are not going to do anything. I would assume so. But I think the moment they give an indication, I think now handling the financial market system is far important for them than controlling the inflation. The moment they take such kind of calls and they start cutting the rates, probably in the middle part of the the current year, we'll probably see the move towards equity taking a positive twist.
But then markets will start talking about elections. Second half of 2023, what will happen in May 2024, that narrative will start.
Now, again, I go with the past trend. I think every year election has always been a big topic of discussions for a variety of reasons. There always a belief, the wider belief that pre-election there will be a pumping of money into the system for building infrastructure and so on and so forth. Fortunately, this government has never done anything just because election is coming, therefore I need to do different. They have been doing it as a work in progress, business as usual kind. Around the year, they have been building this, the whole economic model to the next level. Therefore, I would assume the election-led outcome would be more on the positive side rather than the negative side. It probably can give a positive twist to the market, given the fact that once the election is over, the next 5 years would probably be the next 5 years to look for from Indian economy point of view. Given the fact we will be marching towards fighting our economy, I think we'll also be marching towards making Indian economy to the third number position in the world. So all such things I think will probably shift the attention from global market towards India as we come close to the elections and then beyond.
Does the exposure to cash levels that you're sitting at now increase given the fact that you're saying we are cautious, we are expecting more volatility?
I think the way money managers operates is one, you go and park yourself on stocks which are less volatile and will not have less earning negative surprises, at the same time less downside. That's one way actually go and park yourself. Basically, all these consumption driven companies would probably be the one of the segment in which I think you go and hide yourself. But in addition to that, from a cash flow point of view, money managers generally don't take a big cash calls, which is normally in the range of about 4 to 5%, not more than that.
So consumption is one space which you are suggesting that perhaps one can go and hide. Is it coming, from the fact that it's better to be with domestic cyclicals rather than export-facing sectors like IT, pharma? Is that the rationale?
I think domestic consumption looks like one is in the uptick, and second is the per capita income levels in the country which has been rising. Definitely, I think it will lead to an increase in consumptions. And this time, the rabi crop season has been far superior compared to the last few years. Therefore, the rural economic activities, I think, likely to generally speak up. Therefore, I think the downside risk on the consumption side seems to be limited and probably would have a positive outcome coming from the segment. From IT as a sector point of view, I think we'll have to look at it into exports in two parts. One is IT exports and second is non-IT exports. Clearly, the IT remain an integral part of the global market. And balance sheets are clean and stocks have corrected. And globally, I think all technology companies have corrected quite significantly. And I think Indian IT companies also got corrected quite significantly. Therefore, the valuations become attractive and clean balance sheet, very high cash flows in the books, and high dividend distribution track record and so on and so forth. Therefore, that segment could also play in our own belief is as a contra play.
What about the outlook on the overall private capex? Because we have seen that policy impetus as well coming through. There has been government spending. In light of all of this, are you looking at a decent pickup in private capex, or have you witnessed that?
I think we are already seeing some element of positive momentum in this, especially the companies who have been announcing private capex in the last few months has been the rise, whether it is in the manufacturing, local manufacturing, in the like paint industries, a lot of people have announced, and therefore the capex is coming in. I think it's just a question of time. What we have seen in the last years, post PLI schemes were announced. I think we saw significant announcement coming in the auto space and auto related space. I think we'll probably see a similar trend is emerging. I think most of them, I think, do not hit the headline because they're not in the size of $5 billion, $10 billion kind of private capex, but all in the range of about $1 billion to $3 billion kind of things. And the many companies are actually undertaking that. Therefore, I would assume PLI-led private capex coming in, and also the existing capacity being expanded in certain sectors where the demand for the materials continues to remain very, very large, whether it is in steel, cement, and those are sectors where we are also seeing capex being announced. But all of them actually, in some sense, preparing ourselves for the demand supply situation will change in the next few years.
Let me ask two pointed questions here. First, the SIP cancellations. Now, the USP of India has been that FIs are selling, domestic institutional investors are buying. They are buying because they have flows, which is a function of SIPs. The SIP cancellation ratio, which was reported by press last week, is at a multi-year high. If this cancellation number is strong, that means for the second half of this year, the flows will also dry up.
I think the way Nikunj one should see is cancellation is actually the function of the market sentiment, and I think it's a business as usual kind of things. The ratio only can differ from the normal ratio in the cancellation is roughly about 30-35%. Okay, every time. It's nothing new actually. Now I think people are just looking at the number and then saying SIP cancellations are high. Historically, you have seen, I think the way you have to look at the SIP number is in two ways. One, how many number of people actually keep on buying SIP? That's called SIP registrations. That's gross number we call it.
New people.
Yeah, new people.
Okay.
Even existing people also increase their SIP depending on the market. We call it step up SIPs. So that also people do. There are also step down SIPs. The people who are negative or already enough built, they have built enough book on SIPs. They also cut down their exposures. Also, given the fact the fixed income is also equally attractive today, and compared to the debt, given the fact levels are high as per the interest rate concern, there will be a set of people actually stopping the SIP and moving towards, not stopping SIP, they will be moving towards fixed income as well. So, this is the function of the rates, the function of sentiment, and also the function of how actually business, how the book is being built.
So you don't
but
see
I think
a
if you
drop
look
in
at the,
SIPs.
if you look at the trend, the SIP registration numbers have been going up. The 39,800 crore that you are saying is SIP registrations. Though cancellation would be there, but I think at net level, if you look at it, I think net number is a positive, which is what I think is the case currently. Then we should not worry about it.
So, where I'm coming from or where we are coming from is very simple. Last 12 to 18 months, actually last 2 years, the returns for an SIP investor and for equity investor have not been satisfactory. They have not been very gratifying. They've been negative to flat. And typically, there is a, while we may all think and talk long term, what we actually do is short term. Is there a fear now, given the last 2 years of performance by equity diversified schemes and by equity markets in general, SIP culture could get challenged and SIP cancellations could improve, could increase, which would have impact on net inflows?
So I think the on the incremental flows, in my own belief, is will remain positive.
Okay.
And this will be in excess of roughly about close to about 1.2, 1.3 billion dollar kind of things, close to about 7,800 crores of kind of net
That's the
inflows.
chairman of Amphi or that's CEO of
No, my own estimate.
Okay.
My own estimate, not an Amphi estimate, not Balaji Birla Mutual Fund estimate. My own feeling on
So
the
the
basis of
flash
my
should not
past
say
experience.
Amphi, the flash should not say Birla MC to Bala says.
So on the basis of my past experience, I think that flows will come. I think the trend generally to accept mutual fund through the SIP investing has now become the widely accepted principles. And second is the return driven SIPs, I think has gone down quite significantly. I think it's all gold driven SIPs that has now come in. That also has gained popularity. I think will continue to remain so. But I think the return being negative, I think historical also, whenever the market turns volatile, we have seen 1 or 2 years of dull period when it comes to the question of return. Then naturally people do have some kind of question mark, but that question mark I think gone on quite significantly, given the fact that people anyway look at the future, the purpose for which they are saving. So I think it's a mix of these two things. Therefore, my own belief is on the SIP cancellation is not something one should worry about it. It's a function of market, the trend. But there's nothing to worry about it that I think is something is going to create a negative trend as far as the Indian equity flows concerns.
Okay, my last question is that Adani group of stocks. So let's keep the stock market volatility aside. In terms of your exposure to Adani group of companies, debt exposure, and also for the mutual fund industry per se, has there been any kind of a default, any kind of a problem whatsoever?
Absolutely no. On the contrary, whatever the exposure that even we as a fund house had in Adani group of companies, especially in CPs, all of them are paid on time, and in fact some of them actually even paid before the even the due date.
So Adani group has honored all their debt commitments.
Absolutely yes.
That's for AMC and that's even for
For
other
entire MF industries, banking system, entire financial service industries, whatever the outstanding that was there in form of bonds from Adani group, I think all have been paid on time, and some of them even paid before even time.
And what about NBFC exposure to loan against shares and other instruments?
I think everything has been unwound.
Okay, so there is. So can I say that from an
I think
Adani?
The way I see is, I think I have seen multiple credit cycles, and historically, the last number of years, I think this is the one cycle. Despite a lot of fear was there, has been managed so nicely, given the fact exposures were well controlled, either by the mutual fund industries or by the banking industries. Thanks to the regulatory framework it was there. Even the companies also, and given the past, the way I think markets have behaved, whatever the exposure was taken by the companies are also well manageable even from their own perspectives. Therefore, this time around, though the equity market reacted for a variety of reasons, but the bond market point of view did not react and did not create any fear in the market on potential any credit market crisis. Nothing of that can happen because the entire thing actually was backed by very high prudent norms which everyone would have applied. Even look at this 81 bond of CSFB which now currently is coming. India is far ahead of the curve when it comes to the question of recognizing the risks that are associated with AT&M in the past. And in fact, the mutual fund industry has actually put the risk management system so fast, thanks to the SEBI as a regulator, start asking questions on the exposure to the AT&M bonds in the past. Today, the Indian financial systems are very much under control when it comes to the question of any investments, any bonds which are more riskier in nature.
Well, really appreciate your time. So glad you could join us, and thank you for joining us. Well, here's an excerpt of our chat with Ravi Dharmashi on why he feels that manufacturing has a long way to go in India.
We have been pathetic, if I can use that word, for the last 75 years. We have not done enough to build the manufacturing capacities, and there are many things that that are lagging, whether it is skilled people, engineers being available, women's participation, R&D dollar being spent, the scale that is required, the road infra, logistics, everything has been a problem. Okay, so judiciary, if I may add, the kind of backlog that we have of the cases, the kind of implementation of the commercial contracts, and the back and forth on the taxation, there are many things that keep people off. But, and see, 2014 Make in India started, it was great on intent, but what we realize is that everything goes through a learning curve. You cannot expect it to be a hit from day one. Over a period, government realized that there are too many sectors over here. It is still a motherhood statement. The bureaucrats are not necessarily following the, towing the line. So they changed and they improvised and adapted to make the scheme more effective. They reduced the number of sectors. They incentivized and they used the carrot and stick approach. I mean, I would say Sam, Dam, Dand, Bhed, everything was used. You incentivize with taxes, you give protection with tariffs, you provide a level playing field, and you incentivize scale. PLI, I think, is a game changing. And in fact, they went a step ahead in terms of in defense, where they actually banned imports. So any and everything is being tried. A kitchen sink is being thrown. You are trying to get the logistics in place. We are trying to get the road network, the railway network, the airport network, everything being put in place. And we can see with our eyes, anecdote. We don't need anybody's confirmation that it is improving. Are we there yet? Absolutely not. We might still take another 5 years. But the intent is very clear and the action is also there supporting it. So the confluence of all the steps that have been taken over the last 7-8 years are finally coming to fruition, and we are beginning to see some output or some results, you know, like in the case of electronics manufacturing. We have now gone from being huge importer, mobile manufacturer, we are gone from being importers to exporter. It might be a small number in terms of $1 billion export, but it's a huge thing that we are going to be exporting and not importing. And see, what happens is everybody always starts at the bottom end of the value chain. Okay, you're first going to import everything and get the assembly line in place. As we move along the curve, now again the Foxconn is coming in with a chip plant probably, and the entire ecosystem surrounding the Apple AirPods and iPad is also coming to India. Then we will move along the chain as the component assembly, and eventually the design and the complete product is also finally built in India. I think that day will also come. Maybe it is 5-7 years away. But this is how the trends begin. And all we are saying is that we are at that inflection point, and this trend is going to last long. Manufacturing contributes like 10%, which is lower than some of the even emerging markets. Yeah. So this contribution has to go higher. 25% over a 10-15 year, I would say, is a real possibility, and now we have taken some concrete steps towards achieving it.
All right, that's a word coming in from Ravi Dharmashi. But let's get a move on then and focus in on the company of 5-Star Business, talk a little bit about their growth outlook, their AUM growth, as well as what the guidance is. We've got Lakshmipati Deena Dayalan, who's the CMD of 5-Star Business Finance. Thanks for taking time out. To begin with, the market opportunity in the segment that you cater to is pretty strong, and your AUM has grown over the last few years. What is the outlook in terms of your AUM growth for FY24, and what looks sustainable?
Yeah, good morning all. I think from a growth perspective, as I keep saying, we are very optimistic. Our growth numbers will be very good. Last 2 quarters, we have shown a good growth. This quarter also, we'll be giving a very good growth. And the segment to which we cater, it's completely not catered by many lenders. So we have a big headroom from an opportunity perspective to go and cater them.
Hasn't been a problem for you, and you say that the growth momentum will be sustained. But given the fact that you cater to, let's say, largely the unorganized sector, low income earners, etc., the risk becomes of NPAs and asset quality, right? Because it's just difficult to do the diligence to that level there. I understand that your NPA levels are still very low, but are you worried that they might head a tad bit higher given how the cycle is turning and how entire inflationary pressure is working on the environment?
I think that is what people say year after year, decade after decade, that this segment of customers are more vulnerable. But my personal experience with them for last 20 years, I have not seen any vulnerability because the customers to whom Five Star serves is from essential services, essential shopkeepers to be more precise. See, without them, I think any common man cannot lead their common life. So they are inevitable for any common man to continue his life. So they are so attached to a common man's lifestyle. So I don't think they are vulnerable even in a difficult scenarios. Even though they are vulnerable, I think Five Star product is a secure product. 95% of my loans are backed by self-occupied residential property where the applicant and applicant family members live in. I think they react to a secured lender versus an unsecured lender during the vulnerable times. I think that is where you see the NPAs or 90 plus of Five Star is always stable, and we remain at 1 to 1.5% even during the vulnerable times.
Point taken. But the other thing is that your NIM trajectory is much better than rest of the peers as well who cater to a similar segment, and in the 9 months gone by, it's very close to 18%. What could be a sustainable level for NIMs, let's say in FY24?
I told it earlier, my sustainable NIMs in steady state will be around 13 to 14%. That may kick in next 2 to 3 years. But next quarters, if you see, the NIMs will be in the same level. As you said, that is purely based on two factors. One is Five Star is under leverage. Our leverage is around 1.8. So more you borrow, more the interest cost comes in. Second, I think our cost of funds from the banks where we borrow has come down substantially, close to 150 bips in last 4 to 6 quarters. That is not yet passed on to the customers. We are just waiting for the interest rate cycle to peak, then take the call. So that is why you see little bulged NIMs that you see in Five Star, but sustainable NIMs while catering to this segment will be around 13-14%.
You have historically raised capital via the equity route as well. Going forward, will that be the route? Because if there are two things here, one, it's easy to raise capital from the equity route. Your book value is at a premium to other NBFCs, so it's a good idea. But for a minority shareholder, if you are raising money via the equity route, that could be EPS dilutive.
Again, Nikunj, I have told in earlier show that Five Star capital adequacy is close to 65 to 70%, while NBFC can have 15 to 18% as capital adequacy as per regulation. So even at 30% plus growth year on year for next 5 years, we don't see any capital to be raised for the purpose of the business. So I don't think so we'll come to the market for raising any capital in next 3 to 5 years.
I'm just repeating it again. You will be able to maintain the existing growth rate without any dilution. That is what we should expect from you.
Yes, absolutely.
At what cost are you borrowing from the wholesale market? Because ultimately NBFCs have to borrow from the wholesale market, and the cost of the wholesale market keeps on changing depending on the interest rates.
Currently, we are borrowing at 9.5 to 9.75, Nikunj, from the marquee names with bigger volumes. Even when we see next few quarters, world moves towards little higher rate of interest, our borrowing cost will never cross 10 or 10.25, which is the current cost of fund in my books. So that is why even last time I said I don't intend to pass on any increase in lending cost to my borrowers even next few quarters.
The new RBI guidelines in terms of NPA recognition, what would be the exact change of that? Because that would be applicable for this quarter. So when the numbers will come out, everybody will start saying that NPA बढ़ गया. But that is largely because of the RBI, new guidelines.
From October 1st onwards, our December numbers has that RBI technical NPA, which we call. That has been at 1.45% for 5-star. So 90 plus, which was 1.16% in December, if you add 0.29% to it, which is the new circular's impact on 5-star, our NPA is 1.45%. The guidance, what we have been saying to the market is the difference between 90 plus and so-called technical NPA will be 0.75 to 1%. So at any given point of time, I don't see NPAs crossing 2% even under new RBI regime of this NPA circular.
All right, thank you for taking time out and giving us a view on how things are shaping up at 5-star. Just a quick look at the equity markets. We're at 17,050 right now. It's quiet for the broader end. It's the small cap index actually that is managing to gain 0.5% or so. Within that space, Sequence Scientific holds out. You've got IDBI Bank up about 4%, RITES, Polyplex, PVR, as well as IGL and Adani Green. Those are some of the smart movers. We'll take a short break, but reconnect with us on the other side as we have the management of HAL or Hindustan Aeronautics joining in.
Markets, meanwhile, are not exactly holding on to that early morning advantage. Now, that's a problem. You start strong with the help of global cues, and as the day progresses, the selling is actually been, the uptick is being sold into. So, sustainability now, I think, is really becoming an issue. And now, again, you're almost at the lowest point of the day for the bank Nifty. The small and mid cap stocks, this is not material. The Nifty has to stabilize before anything else. CB Anant Krishnan, Chairman and Managing Director of HAL, joins us now. Mr. Anant Krishnan, good morning. Thank you for joining us. When we spoke to you last, your order book, in a sense, had touched a record high. New orders were coming for both, long format projects and for low format projects. What's the update, sir? How have things moved for HAL in this quarter?
Good morning. Thanks again for this opportunity. And as far as the order book is concerned, last time when we met, we have been indicating a figure of around 83,000 crores. And subsequently, with the addition of HTT 40 and the 6 Dorniers, the order book has now become around 90,000 crores. This is on the firm order book position. And added to that, the last week when the DAC has approved the AON for the Navy utility helicopter, that is the DUHM utility helicopters maritime version, as well as for the 9 Coast Guard of ALH. So there is visibility has further improved with the AONs being there for another 36,000 crores with respect to the orders in the pipeline. So all in all, with a firm order book position of around 90,000 crores, and with further order book where the visibility is very clear, visibility is there, and various stages of negotiations are on, is another 84,000 crores. So almost for 1,70,000 crores in the next 2 to 3 years, the order visibility, clear visibility is there. Added to that, we also expect that there will be a follow-on order of LCH, light combat helicopter, for which that Prachand, for which we had earlier 15 numbers of limited series production. We expect some more orders to come through that since once the delivery will be getting completed in the current financial year, as well as the light utility helicopters, which will also, we expect the further orders to get with the 12 numbers of LSP production. So these two also will get added on in the years to come in the next 2 to 3 years. So with all these things, there is a very clear visibility of the order book position, and the way we execute it at around 25,000 crores, the growth will be quite good in the coming years.
You did flag off the strong order visibility, and you had also submitted bids for orders worth about 3,500 crores for certain orders. When will that be finalized? And what about some of those large ticket orders, the Akash Prime, the land-based and helicopter, EW systems, Rudra radar, etc.? When are they due for finalization, or any others that you'd like to add?
No, but all these systems will get as an integral part of our platforms. That is the aircraft which will get into that. Like for instance, in case of an LCA Mark 1A, these are the systems which will get added, and the certification of these systems is going on. So once we start delivering the aircraft LCA Mark 1A, these systems like EW suite, and then in case of helicopters, the Rudra, WSI systems, all these things will get integrated, and it will get delivered as part of the platform. So today what we are talking about is only the delivery of the platforms, and once the platform is ready for delivery, all the system integration also will happen along with that, and it will be part of the platform deliveries.
And you did talk about that the order visibility is quite strong, but what about execution? Because despite accelerating, your growth rate as far as revenue is concerned continues to be in single digit. When can we see that double digit growth mark, do you believe? FY24, FY25?
Yeah, we have always been maintaining that till FY24, it will be a single digit growth. And once the LCA Mark 1A deliveries start, and with the other orders keeps flowing in, from 2025, 24, 25, that is with the FY25 onwards, we will be in a position to achieve the double digit growth. The current year will be a single digit growth, as we have indicated in our guidance at around 8%. Next year, that is FY24, also will be a single digit growth. But once after beyond FY24, there will be a double digit growth, and the double digit growth is sustainable in the years to come, and it will keep growing.
Contribution of export into this, because right now, of course, the export contribution is quite low. Are you expecting it to increase materially from here on?
Yeah, we expect that the export revenue, we would like to achieve a minimum of 10% revenue in the next 3 to 4 years time frame. We are aggressively following our marketing leads, which we have been getting from the different countries. And now the advantage for HAL has been that we have got a range of indigenously designed and developed products at our kitty, so that we will be in a position to showcase the products. And that is one reason why the countries, also the different countries, have also shown the interest. And with the leads being followed, and we are a little aggressive, we are also planning to establish a separate vertical for the international business. With all these things, we expect that the export revenue will contribute not less than 10% in the next 3 to 4 year time frame.
And I just wanted to understand, because there have been those recent very unfortunate accidents. HAL's manufactured Cheetah aircraft that met with that accident. Do you think it underlines the need to maintain focus on modernization and replacement of the existing fleet, and that could potentially lead to fast tracking of approvals and the ordering process?
Yes, ma'am. As far as the Cheetah accident is concerned, it is still under investigation. We do not know the exact reasons as to what has been the reason for the accident. But notwithstanding that, we have continuously been upgrading the various systems, and in fact, to make it more pilot friendly, and also to see that in all weather condition aircraft, we will be able to operate under all weather condition. So these are all the cockpit is being more modernized, and the systems and accessories are also being modernized. So we are in the continuous improvement process. And the reason for the recent accident of Cheetah is we are still not, it has not been, it is still under investigation. So we will have to wait and watch for that. But as far as HAL is concerned, we are committed to deliver quality products. We are committed to ensure the safety of the aircraft as well as the pilots. So for which, whatever modernization is required, we are continuously on it. We are continuously on the bringing in the improvements to the extent possible.
And we've discussed the order visibility, revenue growth, etc. But what about margins? Because if I have it right, in the 9 months gone by, it was 23.8%. Going forward, what could be the number? Could it be northwards of 24%?
Yeah, we maintain that we will be in a position to maintain the margins. In fact, in the years to come, the margins with the sort of measures which we are taking towards our cost optimization, we should be able to improve the margins as well. But as of now, for the current financial year 22-23, we should be in a position to maintain the 27% of EBITDA margin and operating margin of around 17%. So we will be able to maintain that, and in the years to come, we will be able to not only sustain that but improve on that.
So, sir, apologies, operating margins at what level did you say you'll maintain?
Operating margins will be at 17% and EBITDA margins will be at around 27%.
For taking time out, giving us more clarity on your order book visibility as well as revenue projections. So categorical from HAL saying that even in FY24 we will see single digit revenues. It's only FY25 onwards that the revenue growth will be in double digits and maintained. 10% export growth is what is targeted over the next 3 to 4 years, and the order book visibility is 1.7 lakh crore over the next 2 to 3 years. All right, let's shift gears then. Rohan Gupta of Nuvama as well is joining in on the show. We want to talk a little bit more about their outlook on the specialty chemicals sector as a whole, the take on new age chemicals and much more. Thank you for taking time out. So to begin with, considering that there have been few concerns for the space with respect to growth moderation, demand pressure, etc., is that going to be a huge concern?
Yeah, hi, good morning. So yes, if you look at the specialty chemical, you rightly pointed out that there has been concern on growth moderation from last, I will say 2 quarters. We need to also understand it is coming on a very high base, which the sector has delivered last year. So in FY22 second half and even FY23 first half, we have seen that the many chemical companies, specialty chemical companies have benefited significantly from a very strong pricing environment, and their EBITDA growth was also much ahead than the normal volume growth. It was also having some pricing element. I think that it is just only growth moderation. Probably you will see that the growth moderation may continue for another 2 quarters, and then after that we should be seeing the volume-led growth mainly from these companies. I'm not much worried about the growth moderation because definitely it is coming from the very high base. What we are confident about the volume-led growth and the capex-led growth which these companies will continue to deliver over a medium term.
Exactly my question. We have seen a lot of capex announcements come from these chemical companies and quite large from where they stand currently, whether it's Navin Fluorine, SRF, etc. The capex announcements have been quite solid. Which are the companies that you think stand out, and do you really believe that the demand supply situation allows for such kind of massive increase in the supply?
Yeah, definitely. That's what my point is, that all these companies are putting large capex. It is primarily driven by the huge demand growth visibility. India is not only just seeing the strong domestic demand, but we are also seeing a huge exports opportunities, whether it's in fluorochemicals, whether it's for the catering to agrochemicals globally. All these companies are seeing a strong inflows of inquiries, strong order books, and that's why the capex requirement is there. You rightly pointed once again that these companies have further topped up on their capex plans in last 1.5 years to 2 years. All the cash flows are going there, and even they are some of the companies are leveraging also their debt-free balance sheet for aggressively putting on the capex. And I think that is the right strategy because this sector needs investment to cater strong demand in both domestic as well as global. So yes, SRF, Navin Fluorine, Gujarat Fluoro, Aarti Industries, we are very, very gung-ho on all these companies who are putting capex, and that's where I was talking about the volume growth for all these companies will be coming for in a medium term.
Putting up capacity is easy, but selling that capacity is a function of demand. Global growth is slowing down. Global exports are drying up. What is your understanding of demand of the product?
So Nikunj, there are 2 things to understand. One is the concern on global growth slowing down. When a growth slow down, then most of the global companies will will continue to focus on cost reduction. India is an opportunity for low-cost destination. We are also seeing the opportunities coming from China plus one, and recently very important phenomena I think that which people are forgetting or not giving the right weightage is the Europe energy crisis. Many European companies are going to face the cost pressure because the energy cost in Europe is not going to be same what it was earlier. So you have a very solid domestic demand, a China plus one, a Europe's energy crisis, and global players' requirement to continuously bring down their cost that can only be achieved through outsourcing. So here we are the country which offers the all this advantage, and that's where, despite a global slowdown, I think that the outsourcing opportunities and domestic growth, all these things are going to drive the capacity, drive the demand for Indian chemicals manufacturer, and that's why I'm not much worried about the demand supply mismatch, or these companies who are putting capex, they will be able to use these capex optimally.
China plus one is the concept which started post-COVID, and post-COVID China is not has been both on and off. Now that China has opened convincingly, will there be a realistic shift in China plus one strategy? Because it's easy to discuss a strategy when China is not operating. Now is the real test.
So, Nikunj, once again, we need to understand that China has been a biggest disruptor, not only just pre-COVID, but even before that. Many of the end user industries who have been dependent on China for their requirements solely, they have been facing disruption or supply chain disruption. For a company or end user industries like FMCG or consumer durable, the disruption in supply chain is the biggest deterrent. I think that from 2015 onwards, many global companies have already been looking the alternative. It has just only increased, or intensity only increased post-COVID. So China coming back is not a solution for the global player, because they definitely need a second other alternative than China, because they have seen a multiple disruption in China. And also understand, even within China also, the cost structure has been continuously going up. Since 2015, many chemical industries, chemical parks in China has been relocated, shut down. Their cost structure has gone up massively. That's where the Indian players comes in play. We now have a level playing field. There is no extra benefit to the Chinese manufacturer, and that's where the advantage comes to Indian players now, and that's what gives us the confidence that the China plus one, or simple, it's a global end user industries are going to add one more source than China. It may be either Malaysia, Thailand, India, and I understand that India is the biggest beneficiary or the most suitable after China.
All right. And, given that we also met up with Tata Chemicals Management, and they highlighted that the US is emerging as low-cost penetration center for energy-intensive sector, how does that augur for India?
So that is a very specific view which you are talking about, only limited to soda ash. So yes, because US have some soda ash assets, and there they have the mining process through the Trona process. So that is only limited up to the soda ash, and it's not applicable on entire chemical industry. That's the only one particular one product. And there also we think that the definitely US will have an advantage in terms of natural soda ash. But yes, synthetic soda ash still will continue to remain dominating factor, and it will all dependent on from how far they can export from the US. So I think it's only specific to the one particular product, the dynamic which you're talking about.
And we let you go on that note. Thank you so much for joining in and talking to us about how the entire dynamics is shaping up when it comes to the chemical sector as a whole. For the market, 17,050 is where we're at. So just maintaining around that level. There's not a big move either on the upside or on the downside. So very, very sideways. That's the way the market really continues to be at this point of time. Let's take a look at individual movers if there are any. Sterling Wilson, of course, is reacting to the news flow of the order win. So it's up around 6%. IDBI Bank is also perking up with a gain of around 5%. And UTI AMC is also having a good day, up around 5%. GAIL, I'm guessing there might be a bit of technical adjustment there, 4% lower. And Biocon is the other one which continues to reel under pressure. Yesterday also it was down in trade. Today a downtick of 3%. And L&T Tech, wherein one of the brokerages, I think Citi, had opened a negative catalyst watch, is also down about 3%. So those are some of the counters that we are watching out at this point of time. But let's shift focus to what's happening in the travel industry, and let's understand it's better with Ms. Khaled, the chairperson and managing director at Dreamfolks as well. Hi, thank you so much for making time and speaking with us. Well, as per reports, India is still at a very nascent stage in terms of the airport lounge product life cycle. Is this a bit of a concern for your own long-term growth trajectory? How are you looking at how the growth outlook stands for the company?
If you actually see the way the airport traffic is growing, right, and now also if you see that the expectation is around more than 20% growth in domestic, and international is around 27% growth. So I don't see a concern, and we have also seen a good trend going on. And in terms of the lounges itself, if you actually see that, it's not just the metro cities, but we also see a good attraction happening in the tier 2 and tier 3 cities as well.
So what about your outlook on margins? Will they be maintained in double digits?
So I would say that, if you actually see our past history also, that, we are now trying to maintain the margins, and we will continue doing that. And that is what, as a management, we have, done our plans. And it is not just with the lounges, but all the other services what we have added will continue to, have the same double-digit margins with us.
And I understand that you plan to replicate the industry knowledge in high growth markets. So which are the new markets that you are looking to enter? I understand there were plans for the Middle East and Southeast Asia as well.
So in terms of the other market, yes, the plan is to, diversify in Southeast Asia market and Middle East. We have already started our, work there. And the strategy is that the way we have actually built and differentiated, created a differentiator in India market in terms of the solution, in terms of the service offerings. So in the similar lines, we would also try to capture the other market, which would be Middle East and Southeast Asia. The work has already started. We also have team in these regions as well.
So how will you capitalize on the market potential given the rise in or jump in the air traffic, credit card users, number of airports, airport privatization? Everything is now falling in line for your business.
So if you actually see in terms of, the lounges, if I have to start with, right? And just to give you a prospect that, when we started this business, the average lounge size used to be around 2,000 square feet, which today, if you actually see, the average lounge size is around 30,000 square feet, right? And not only that, there were only one lounges per airport, especially the metro cities. But today, there are multiple lounges in the metro cities. Not only that, the privatization happening in tier 2, tier 3 cities, that is also adding value to our business. So obviously this is going to be an additional thing. Apart from the lounges, I would say the other services which are there, which we have added, starting from meet and assist to airport transfer to spa, F&B, the transit hotels, and now exploring into railway lounges as well. So I think yes, I would say that in terms of the diversification of our services, and in terms of, I would say, the additional spaces which the airports are actually carving out for the lounges, I would say that, these are something which are going to be beneficial for our business.
The acquisition of Vitsul Golf and Wellness Services, which is picking up the airport, what are the other acquisitions which are there on your radar?
So presently, yes, you're right that we have just acquired Witzer Golf, which is again into golf. So presently, yes, the focus is to build the golf program into our portfolio. So right now there is no such plan, but yes, as and when we see that there is any new service or any something which is going to complement our business, we will look at it. But presently, I would say there is no such plans.
Okay, thank you, ma'am, for joining us. We'll definitely speak when there are further announcements on acquisition and the business strategy. Appreciate your time in speaking with ET now today. A bit of a pickup in the market, that's quite visible because we are past the level of 17,050 now. Let's see where we head from here on, but definitely some momentum building up as far as Nifty as well as the broader markets is concerned, with the small cap index now up around 0.8%. So it's the market breadth which is actually quite positive today. Let's try and understand it better with our technical experts. They're joining us for our chartbusters segment. Nooresh, you go first. What's the stock that you are recommending today?
So that is Axis Bank. The stock for a long period of time had a huge resistance around 800 to 820 levels. 810 was a high for the whole of 2022. Gave a breakout move. Then we saw that huge bump up on results. A little bit of a dip and then went all the way to 960. In the current move, the stock has again retested that 810 levels and is now making a reversal. Now, this is a good entry point for the medium-term investor to long-term investor, wherein if it holds above 800, this could again be going back to all-time highs. So for now, initially starting off with a bounce back trade, a stop loss at 810 and a target price of 900 to 950 in the short term.
You, Kunal, what are you spotting as a chartbuster idea?
So it's on Bank Nifty, Nishan. Interesting patterns for Bank Nifty because on the early charts, the Bank Nifty is forming a classical inverted head and shoulder pattern. The breakout of this pattern is around 39,700 mark on the spot levels, and we are somewhere around 150 points away from those breakout points on the Bank Nifty. I believe that whenever we tend to confirm this breakout and close above this 39,700 mark, it could result into a steady up move for the index, and this rally would probably gain a lot more prominence. So that's why I believe that betting on banks, especially the large cap private sector banks, as well as a couple of stronger PSU names, I think would be a better play at current zone.
Okay, before we ask you about your top ideas at this point of time, I wanted your take, Kunal, about a couple of big buzzers at this point of time, and they're moving on heavy volumes. Aarti Drugs, it was logged in upper circuit yesterday, 20% higher. Today as well, it's trending a bit high. And UTI AMC, it doesn't usually move that much, but today it's up 6% on heavy volumes.
So yeah, Aarti Drugs is quite interesting because after being beaten down significantly for many days as well as many weeks, the stock has seen a decent recovery. I would probably expect that today as well as tomorrow, you might see probably the stock getting into a bit of profit booking because after such a kind of a sharp correction and a very strong candlestick move, you can expect that the stock would probably get into a time-wise as well as a price-wise correction. But then I think those dips could be good opportunities to buy. For UTI AMC, the stock has been again a bit more volatile. In fact, today the theme for many of these market-related sectors is financial services, the AMC stocks. These stocks are making a comeback for themselves. So my probably expectation is that this has got to do with the trend for the market right now. You may expect the stock to get into another rally, maybe another 30 points on the upside, 5.5% further from current levels could be a near-term target for UTI AMC.
Those are the takes coming in on UTI AMC as well as Aarti Drugs. But let's get the top recommendations out of the way then. Nooresh, you go first. What are the top picks?
So first is a buy on L&T. The stock is trying to make that breakout move out 2200, 2220. A stop loss at 2140 and a target price of 2400 plus in the short term. Second is a risk reward trade. Infosys is back to 1400 levels, keeping a strict stop loss at 1380 and a bounce back target of 1500.
What about you, Kunal? What are the top mid-cap recommendations?
So the first one is by Navin Fluorine. The stock has made a very good comeback about the 4,300 mark. So would suggest a buy with targets of 4,500, stop loss at 4,270. And Bank of Baroda, as I just alluded some time back, that most of the PSU banking stocks could make a strong comeback. Betting on Bank of Baroda, targets of 166, stop loss at 158.
On that note, we'll slip into a very short break with the news that the Nifty is now at 17,070. There's a sector-wise, it's a decent mix coming in for most of the sectors trading in the green. It's only IT which is on the back foot, and FMCG that was outperforming yesterday is a bit sluggish today. Except Nestle, the other big names are actually trading in the red with HUL, etc. on the back foot. We'll slip into that very short break and be right back.